Our next guest says he's been bullish about equities for more than 2 years now and still remains overweight equities going into this year with a target of 12 to 15% for stocks this year in terms of performance. We'll find out more now from Ryan Detrick, Chief Market Strategist at Carson Group. Hi, Ryan. Thanks for joining us.
Happy 2025, and thank you for having me back. I appreciate it.
Happy 25 to you as well. We know that 23 and 24 were very good, and there is not a consensus, but a lot of people, as you know, who say, well, it's impossible to keep going up after 2 big years. But you think stocks will keep moving higher, albeit at a slightly lower pace, but double digits. So what are your main reasons for that?
That's right. You know, again, when we were bullish 2 years ago, it wasn't very popular. Even last year, it felt a little lonely. Now, it's a little more consensus that we're probably in a bull market. Now, there's different ways to look at this. I'll just put it this way for the listeners. After any year you gain 20% on the S&P, that next year is actually higher, like 82% of the time, up double digits on average. So better than average returns after a 20% gain. After back-to-back 20% years on the S&P, that following year has been higher, 20% on average, and never lower. Now, let's be clear, it's only happened 4 times since 1950, so I'm talking pretty small sample size. Just some context around that, because we're up a lot, doesn't mean you have to go down. I hear that a lot, and that's not the case. Now, you look at this market, I'll kind of make this, kind of throw a few things here quickly. We see very strong productivity in the United States. We've been seeing that for 6 quarters now. We think that continues. Productivity is this kind of magic elixir that allows for better earnings, that allows for better economic growth, which is exactly what we've been seeing. You look at the U.S. consumer, incomes are still really, really solid. The job market, is it slowing? Yes. Is it cracking? Maybe in some places. But if you still have people employed, you still have incomes that are solid, we can get into all the weeds of it. We just think those are the things that brought us to the dance, and those are reasons we still think this bull market is alive and well. I know it's been a little dicey the last 2 weeks or so, but all in all, we still think in a year from now, we'll probably be up, well into the teens on the S&P 500.
All right, Ryan, when it comes to inflation and the Federal Reserve, there are those who believe that inflation is kind of sticky. It's ticking higher, heading towards 3, heading in the wrong direction. But do you think that the Fed is actually going to cut rates more than expected and more than's being priced in right now? Why?
That's right. When we look at inflation, we saw some inflation data at the end of the year in the United States. It was a little bit on what they told us was sticky side. But and I'm sure you've had tons of guests talk about this, but if you look at shelter is a lagging indicator in the United States. Take out shelter. Inflation's running sub 2% in the United States. Okay. I mean, people know this. We know this. Look at real-time rent prices. The government in the U.S. says rents are running like 4.5%, 5% year over year. Real-time data, Apartment List, Zillow, places like that are negative. So we know this is coming. So those are positive things on the inflation front. Goods prices were down last year. I'm not saying it's perfect. We're just saying you do not need interest rates as high as they are with inflation coming back. And I think once we get into the Fed's not going to do anything probably for the first quarter or so. Once we start to see inflation continue to improve, that opens the door, in our opinion, for the Fed to cut a little bit more. I think the market's saying maybe 2 cuts this year. Don't forget, this time a year ago, the market was saying 6 or 7 cuts, okay? We never thought we'd have that many because we thought the economy would be a little stronger. We actually were on record of saying 3 or 4 cuts last year. That came in. Now we think the market swung a little too far the other way, a little too hawkish. That's what the Fed has told us. They were a little hawkish with that last interest rate cut that they did. But again, we think that can swing back. And then to put a cherry on top, productivity. I started with this. When you have stronger productivity, it allows to pay higher wages. The Fed can cut, and you do not see a surge in inflation. That is what we saw in the mid to late 90s. I know that's a perfect scenario, kind of, but that's where we are. So strong productivity allows cover for the Fed to cut and still pay higher wages, not worry about a massive spike in inflation. So that's kind of where we are with it.
Ryan, in terms of small caps, you expect them to lead. Small caps had a big November. There wasn't a lot of follow through. So tell us why the small caps are going to have a good year, and what are the risks to that scenario?
Yeah, well, the risks are they keep lagging. Feel like they've been doing it for a while. Listen, small caps last year in the United States are up about 12, 13%. Obviously, large caps are up double that. We all know that. But we like small caps. We also like mid caps, right? We think that for a diversified portfolio, for investors listening right now, the stock market is pricey. If you look at forward PE multiples, they are pricey. But there are other parts of the market that aren't, specifically small caps, mid caps, areas like industrials, financials, some of those cyclicals. It's because tech and communication services, where the growth is coming from, let's be very clear, those parts are pricey. So if you've got an investor who wants to diversify their portfolio after the gains they've had in technology the last 2 years, we think it makes sense to kind of buy some of the other parts of the market. Now, to get more specifically to your question, it is what it is. Higher rates don't like small caps, or small caps don't like higher rates. Kind of the conversation we just had, I think the Fed's going to cut a little bit more. Look at the U.S. dollar. U.S. dollar has been so darn strong, specifically all year, but really since the election. I think it's a one-sided trade. Everybody's bullish the dollar. You think about it, there's probably opportunity on the other sides. But dollar starts to come back, yields start to come back, the U.S. economy remains strong. Those are all fundamental reasons we like small caps and mid caps, honestly, in a diversified portfolio. One more stat for you. S&P 500 expected to grow earnings about 14 to 15%, depending on your source, in 2025. Russell 2000 earnings, small caps, expected to grow like 50%. So there is a lot. Now, that's because they've struggled. I mean, let's be clear. It's not like they've been doing great. It's because their earnings weren't as good. But they're playing catch up in a big way. So some lower yields, a lower dollar, strong economy, cheap valuations. Those are all reasons we think, from a diversified portfolio point of view, you want to have some small and mid cap exposure in 2025.
Just lastly here, Ryan, just about 30 seconds. You say the bull market is really only a couple of years old. And if you go back in history, oftentimes bull markets last multiple years. And so are we still early days here?
Yeah, I know this confuses people or upsets a lot of people, but yes, right. This bull market's over 2 years old. Started October of 22. That's when the bear market ended. And put it like this: it's like a cruise ship, right? Once a bull market gets going, it keeps going. It's hard to stop a cruise ship once it gets going. Looking at 5 bull markets going back 50 years that made it into their 3rd year, like this one is right now. The average is at least 5 years. We've had them go 8 years. We've had them go like almost 13 years. We're not saying that's going to be the case. I just want to point out the fact that bull markets tend to last a lot longer than you think. Something for everybody, and I'll be quiet. The 3rd year bull markets can be choppy and a little frustrating, although we do think we'll have a better year. Just be aware, third year you can catch your breath. That's why we think there probably will be a 10 to 12% correction at some point during the year. Prepare for the volatility now, but when all is said and done, it's still a bull market.